We are talking with Ryan, who has gone and left big corporate world, big consulting for one of the big four, and went out and bought his own business, and now is going down the acquisition route, talking about but what to look for in your acquisitions, should you even buy a business, and what his process is for buying a business. Ryan, so you started with the big four. Tell me about that and what made you want to switch.
Yeah, I always wanted to get into the big four. I went to a small Christian college and we actually had four accounting majors in my graduating class. And so to even talk to a big four was a pretty big deal. And so I worked so hard to get into a big four during college. I actually applied to Deloitte 27 times before I got an interview. And I don't know if they felt bad for me or whatever, but I finally got in and it was probably almost about a year and a half in. I was having a conversation with our partner on his rooftop in Chicago, and he's like, being partner is great and all, but my daughter just turned 18 and I've only been to three of her soccer games in her entire life. And that kind of stuck with me. And I was like, well, I don't really, yeah, the money's great and the prestige is great and all, but I don't want to be that same guy saying I've only been to three of my daughter's soccer games, right? Like I want to be the coach. I want to be there. I want to be involved and active. And so the very next day I formed my first LLC. This was probably circa April 21. And I started, moonlighting and planning my own version of a Shawshank Redemption escape plan from a corporate America. And 6 or 7 months later, I had enough revenue that I was making on the side that was more than my $64,000 salary at Deloitte at the time. And I thought, well, okay, if I was making this much money, only working 15 or 20 hours a week, imagine if I put my whole heart and soul into it. And that first year, it's scary. Like, because your parents are like, well, you work so hard for this job. Why do you want to quit now? Your in-laws are telling you the same thing. Your friends are telling you the same thing. Everybody's saying like, what if it goes wrong? But nobody ever says, what if it was better than you ever imagined? And that's what it was for me. Like, my first year goal was to hit 150K net being self-employed. And I thought, okay, if I can hit that, that'd be great. And it was a lot better than that. You know, basically 8x'd the part-time revenue first full-time year and then doubled that again, and just learned so much along the way uh, through entrepreneurship and actually running a business.
What are some of the biggest things you said you learned so much along the way? What are some of those key lessons that you learned?
I think the first thing is identifying your ideal customer and your ICP, like your customer profile, because in the beginning, if you're self-employed and you're depending on you for a paycheck and not an employer, it can be really easy to just take on any and every client with a pulse that's willing to pay you a fee. But what happens is over time, you really narrow down and understand who you truly like to work with. And that normally comes with higher level services and higher fees. And so if you don't do this in the beginning, a year or two in, you're stuck with, well, you got, you know, 50 clients paying $5,000 a year, and then you got 50 clients only paying $800 to $1,200 a year. And it's like, you want to give time and attention to everybody, but it's really hard to give time and attention to somebody that's paying a fifth of what other people are paying. Versus
Yeah.
if you know right away, like, okay, I'm going to set the bar high, I'm going to set my prices high, and here's exactly who we work with, then you don't ever run into that problem.
I think you mentioned something interesting there. If you find the clients that don't necessarily, if they're not paying a ton, you can end up losing money on fulfilling for them. And so essentially you're paying them to do their work.
Yeah, it's pretty much the reverse of the Robin Hood, modern day Robin Hood. Like you're cannibalizing your time and your team's time because half the time is going to be spent on the clients paying four times less, and then the other half is going to be spent on the clients paying five times more. And so ideally you want to keep fees, pretty consistent across the board.
For everyone for whatever that unit of time is. I think in corporate they measure a lot of things in work hours. Is that how it was in Deloitte?
Yeah, at Deloitte, it's based off of hourly billing rate. Um, So to those guys, it doesn't necessarily matter as much. But when you're doing fixed fee engagements, you're not billing based on the hours. You're billing one price, and whether it takes 5 hours, 10 hours, 15 hours, that's where the efficiency comes in because it might take 5 hours to do the same amount of work of a $5,000 project versus a $1,200 project. And so which one are you losing money on? Well, you're losing money because that time that you spent on the $1,200 client should have been spent on a $5,000 client.
Mm. Well, one of the things that's interesting about going from your corporate to your own business is you managed to scale what I would consider to be relatively fast. What was essentially, your moonlighting, it's part time, it's your side hustle, which then became your main gig. How did you go about marketing? Because a lot of people take years to figure out how to get their first customers, if they even like just execute on it as well. But the fact that you were able to grow so fast in such a short amount of time, that's really impressive. I think not many people can probably attest to saying, "Hey, I had this much explosive growth in my first year of starting full time."
Yeah, marketing is everything. People, especially in the accounting and professional services industry, the founder doesn't believe that they have a marketing problem because oftentimes, their phone's ringing off the hook with leads and prospects, but they do because they have an ideal client marketing problem. And until you can niche down and take on a very specific client, like ours just happens to be real estate, and you can speak their lingo and you have to know the terminology. You have to know about what's in a real estate contract, what is an inspection contingency, an appraisal contingency. Like, how are you helping your clients just outside of what you're doing on a day to day, like tax work, and turn yourself into like an actual advisor. Um, you have to know the lingo that your prospects speak, and if you want to be successful, it's just like, and they can tell right away. They can tell when they go to a CPA that knows real estate, how they talk versus one that doesn't necessarily handle a lot of real estate clients. It reminds me of my grandma grew up on a farm, 13 kids, and when me and my brother were younger, we'd go on the same farm, and my grandma would show us like the sheep, the horses, the cows, the pigs, and one time she took us in this barn and she goes, Ryan, horses and donkeys look a lot alike when they're younger, but you can tell a horse from a donkey when it opens its mouth because a donkey goes ee-ah, ee-ah, and the
Yeah.
horse goes neigh. But like that's people. Like you can tell the clients can sniff that out whether or not you know your stuff or not. And they just happen to pay more for experts. Think about a doctor that's a general doctor versus a doctor that does specifically hand surgery or facial reconstruction, right? People will pay for the experts, and that's my biggest piece of advice is to niche. If you're going to start a business, you should niche down.
Yeah, that makes sense. And when you say niche down, what does that mean? Because that could mean so many different things. I think a lot of people say niche down, niche down, niche down, but they don't actually able to like define what does that mean. So when you say niche down, what does that mean to you, and what does that look like to find your niche?
All of your marketing and your speaking and your storytelling and your language and your copy needs to be intended for that ideal customer. And it goes above and beyond like, oh, they just want to save so much money in taxes. Like, what else keeps them up at night? What else are they thinking about that they won't even admit to you on the call? Because oftentimes in sales, it's the elephant in the room that the prospect won't admit that's keeping them from signing up with you. Niching is niching is important because also if you have an ideal client, you can build systems and SOPs, processes around that ideal client. So that way, 2, 3 years in, there hasn't been much that you haven't seen before. So like on a real estate side, like we've already done any sort of 1031 exchange imaginable, whether you're going from one property to three or three to one or two to four. Um, we've already done all types of fix and flip transactions. We've already done any type of any type of transaction a client comes with us nowadays, we've already helped somebody do that before. We've already helped them work around selling a company. And so niching in a specific target market allows you to build systems around that versus just being a generalist. And now I have to come up with systems and processes for each different business niche, right?
So not reworking. So if you're working with a bunch of different clients, you're going to have to reinvent the wheel each time versus getting really clear on where your customer is then and then where they're going to be after your product. I think people should create a customer journey for both people. You should create it for yourself, your own customer journey of what it looks like when they start working with you versus when they have already achieved their first desired outcome. If you have upsells, obviously that's a different conversation, but as well as what the customer experience is. Most people don't really remember what is the customer experience for this. So if you order something from Amazon, for example, your customer journey is relatively simple. You look something up online, you hit buy or whatever, add to cart, and it arrives. That's your customer journey. It's as frictionless as possible, as easy as possible. Versus Amazon, I think there's a lot more that goes on in the back end. So there's two customer journeys going on simultaneously. And people don't have enough empathy with what their customer is going through. And I agree, really learning about where your customer's at. Dan Kennedy's 10 questions in advertising, I think is one of my favorite things. If you're familiar with that.
I'm very familiar.
Yeah.
Yeah.
I think that it's one of the most helpful ways because it puts a title or a label. It gives you words to be able to identify what your customer is going through. And I'll read those out now because that's, I think, pretty relevant. One, what keeps your customer awake at night? Indigestion, boiling up in their esophagus, eyes open, staring at the ceiling. Very descriptive, right? It's not just like, what are they worried about, right? Number two is what are they afraid of most and most frequently? Number three is what are they angry about or who are they angry at? Number four is what are their top three daily frustrations? And I think a lot of these are really good because they re-ask the same question or a similar question in a different way, which helps you think about it in a different way. Because most people, they stop at that one level deep. What really where you win is when you go there's seven levels deep, you can go as deep as possible to really, really, really understand. I think the person who understands the customer the most will end up winning at the end because like you're talking about these exchanges that you have the real estate exchanges, that's something that someone only really niched in real estate would understand. And so you can speak to that person who is dealing with that really specific struggle. And ideally, your customer says in their head, he gets me. They get my problems. And I think once you can get inside your customer's head and that person says, this person understands me, that's when you've won.
Two things. Once you check out from Amazon, what page do they show you after you check out? What happens at the little bottom of the page? What do they show you?
It's a type of order bump. They show you other things you might be interested in.
Correct, right? So that's also part of niching down and understanding your customer's problem is being that person that, oh, you're hiring me or you're paying me to help you solve this problem. I know that you're also going to run into X, Y, Z in the third. We can connect you with those people too. Um, most of the time, your customer's opening their wallet to pay you. What are they keeping their wallet open for? Right? Is the idea. Um, and a lot of times people need somebody that they can look up to and that they can get advice from because oftentimes people are just walking around with their umbilical cord in their hand looking for somebody to plug it into. And if you can be that expert that they plug their umbilical cord into, they'll take your advice for forever. Um, the customer journey also, with Amazon, sometimes it's not as straightforward as you log into Amazon and you already want to buy something. Normally what happens is you think you want to buy something, you start searching it online. And then what does Facebook do? Facebook shows that thing that you want to buy in the little top right of your Facebook, right? The sponsored post, because of course our phones are listening to us 24/7. Or like maybe you go to Amazon and you search that product, but you don't buy it, and then it shows up in your Facebook. That, in marketing we call that retargeting. So if somebody downloads this thing of mine, but they don't continue on in the process, like they get retargeted and brought back in. It's like, hey, are you still interested in this? Or what other problems can we help you with? So there's so much, most business owners don't think a lot about how does their customer actually go from unaware that they have a problem at all to you're the best solution for them, and showing them a roadmap, like you said, is very helpful because they can label themselves and they can put themselves in that roadmap and it allows them to make an easier buying decision.
Hmm. And I think to your point about like positioning, zero sum, meaning the winner takes all. And so the more that you can understand your customer, the more business that you're going to get. And it's way easier to be at the top of the zero sum than it is at the end of zero sum being exponential, right? There's a reason we call them the big four, not the big 100, is because the top accounting firms take a large market share of what I would consider the profitable work to be done in consulting. That's why they're the top. And that's you mentioned that prestige that they have. So I completely agree. And so how do you become that expert within your niche? And it's easier to compete in a smaller niche than it is a bigger niche of understanding who it is. Who are we talking to? Who has a problem that we can solve? Hmm. So after Deloitte, by the way, you went and decided that you were going to go down the acquisition route. And this was after you had already started your own profitable company, which is, I think, an important step. Even though you're about to go acquire a business, you still look at this and say, well, I still need to learn how to manage money before, or how to manage a business before I go out and buy a business, right? I'm assuming that's the thought process there.
Yeah, and after, looking at the time that it took me to get to a certain amount of revenue, albeit that it was a short time, 3 or 4 years, I realized like, well, if I wanted to double revenue, that's going to require a certain amount of ad spend, certain amount of book sales calls. We're going to have to pay commissions on those sales calls. If I wanted to double my revenue, meaning I probably would have to 60 to 70% increase my client base. I would also probably have to increase my staff by 50% or more. I kept going back and forth and I found out that the easiest, quickest, and sometimes cheapest way is to acquire other companies to get to that revenue growth, as opposed to trying to do it organically or just spend a bunch of money in ads.
Hmm, interesting. Yeah, and there's costs associated with every single other thing there. You're talking about hiring, which if you're paying a recruiter, that can cost money. You're also talking about opportunity costs. So what is it going to cost if I wait a year before I get these customers versus I get the customers down? Of course, in a big consulting land, or I'd say big accounting world, they teach you the time value of money, right?
Yeah,
So it really is about, hey, a dollar today is going to be worth way more than a dollar tomorrow.
yeah.
When you decided, hey, I'm going to pull the trigger on the acquisition, how long was it before making that decision before you were able to make your first acquisition?
Well, I had been looking and just looking at deals for probably on and off, I would say like 8 to 9 months. I probably looked at over 75, 80 accounting firms to buy, all of them, which, by the way, they were listed on some sort of brokerage platform. And in real estate, they teach you a lot like, hey, you really get good deals if one of these three things occurs. The person dies, there's a divorce, or there's some extreme distress going on that happens. Um, and in the case of the accounting firm that I bought, there was two of those three things, and that's what presented like a good deal, a good opportunity. This firm that I bought wasn't listed on a broker website. It kind of just it came in through my network of people, of talking to people, and based on the numbers, I was able to make a pretty quick decision of like just like a rental property, I can look at a rental property in 5 minutes and know if I want to continue to pursue it further or if I want to pass. And just knowing like, gross revenue, client count, the staff that they had in place, like I knew that that was something I should jump on. And um, between when I found out about that opportunity and when I closed on the company was probably about 6 months, six to
Which
seven
is
months.
relatively short.
Yeah.
Some acquisitions can take much longer. Did you know right away that this is what you wanted to purchase, or did it take you a little bit to figure that out during the due diligence process?
Yeah, so even before like submitting an LOI, there's some key things that I personally look at in firms if I'm going to buy them or if I'm going to recommend that somebody buys them. I'm happy to share that with you if that'd be helpful.
Sure.
Yeah. So the first thing that I look at is the ratio of revenue to clients. So I'll give you an example. Like there was a firm down the street from me that it was like 1.6, 1.7 million revenue. Owner was taking home 8 or 900K. Great margins. They were doing 5,500 tax returns. 5,500, just cranking them out, simple, easy 1040s, but they were doing like volume, and I didn't want that. I want, my ideal customer profile. So that's something I stay away from is if the revenue versus clients is too low. Like ideally, I want revenue to client ratio to be 6 to 7,000 per year. Now you're gonna have some clients that are just 1040 only, And then you're going to have some clients that sign up for the whole package. But ideally, you want to have that ratio be something that you're acceptable with, because otherwise you're going to run into the same issue. You got this firm over here where your average ticket's 6 or 7K. Then you got this firm over here where you got a bunch of these $1,000, $2,000 relationships, and you're not going to want to service those customers the same way you do the ones that are paying 3 times more. So revenue versus like client count is important. And then within the client count, how many of them are business owners and file business returns versus just their individual 1040. So ideally, you want the ratio to be at least 50%. So if I have 500 1040s, I want to have at least 250 to 300 business returns because those clients are going to be less likely to leave and churn because they have everything at that accounting firm. Doesn't mean they won't, but they're less likely to leave because of that. Versus somebody that is like a 1040 only, they're more susceptible to flight, to leaving.
Hmm.
Um, Age of clients is important. I got this deal that was sent to me Monday last week, and it was like 35 to 40% of the clients were already filing 1040 senior returns, meaning they're 65 and over. So then I'm thinking like, well, one of the first questions I'm going to ask is how many of these other clients are about to retire out. Um, so that's something we look for. We look for virtual, like, virtual versus on site. Like how many of the clients actually come into the office versus are okay with it doing it online? Because I live in Chicago. If I'm going to buy a firm in Arizona or LA, it needs to be able to operate without me being there and minimal staff involvement, if that. So that's an important thing. I think all else equal, virtual versus a brick and mortar. I think virtual firms are selling probably, if you had to ask me, they're going to sell for 30 to 40% higher than what a brick and mortar would.
Wow.
I
What do you
think
think?
so.
What do you think the reason for that expansion, the value premium on the virtual versus in-person firms?
Because anybody can acquire it and be successful.
Mm. So
Versus
there's
if
more
you,
more competition for the purchase.
yeah, if you are going to keep the brick and mortar, then you're going to need highly trained staff to sit inside of that office, and you're going to have to continue to keep the office space. And there's just so many more things that can go wrong versus a company where all the clients are used to interacting virtually, and then you're taking your company, global rather than just finite into an office space. So I think even if you look at $1 million revenue firm right now that's brick and mortar versus $1 million revenue firm that's all virtual, that virtual one I guarantee will sell for 1.5 to probably 1.5 million compared to the brick and mortar is going to sell for 1 million,
Hmm.
most likely. At least that's what I've been seeing.
It's interesting that you mentioned also about finding the right type of target to buy. Who are we going to buy and why are we going to buy them? And I'd say this is a very good demonstrated in Waste Management. Waste Management is a company that went in and had a platform company that they buy. So they had a really big acquisition at first as their first company, and then they went out and bought a bunch of smaller companies and then put them together. And there was a lot of value being created in the valuation of the company by putting them together. So you had, let's just say that your main company is trading at a 30x multiple of profit, which is often how these businesses are bought, and you have a smaller company that's trading at a 5x multiple of profit. So that could be even if the same profit margin is true, if it's just a smaller business and you acquire that, you're instantly making that business more valuable as
600%.
long as the integration is there, which I think is the important part. You had said no to deals earlier. Even if you could have bought that business, it may not have turned out well for you. It may have been more of a headache than just going out and marketing and hiring the people yourself. But finding the right type of acquisition, putting them together, and so that's where some enterprise value is created. If the exit is the goal in mind, um, as well as if depending on how stable the cash flows are, right? I think it's a pretty stable cash flow business, CPA firms in general, and that's actually one of the reasons that we were looking into. I think acquisition of a CPA firm makes sense for us, but about what type of CPA firm, because we didn't want to just do any CPA firm. We had very specific criteria around our acquisition. Even before we started talking, we were um, pretty picky on what we were or weren't going to choose for our acquisition target. So, what was was it difficult to say no to a deal, even if you have a really good deal that comes, walks into your door, say, "Hey, I want to sell." that can be kind of rare. What was it that made you like, hey, I have to have the discipline to say no?
Yeah, and in sports, yeah, I played college volleyball for 4 years at a really high level. I remember my coach would always tell us like we don't rise to the occasion, we revert back to our training. And my training for deal buying was here's my specific buy box and my criteria, and this is what I'm looking for. And there might be a couple of things that fall out of line or that don't meet it, and that's okay if the greater sum is still okay. But if it doesn't check a couple of these boxes, then it's a no for me. Um, it reminds me of I have a my grandpa, he was a huge baseball fan, and he loved Ted Williams was his favorite player. Ted Williams was uh, he was like an all-star World Series champion. He served in the military, came back, was still like crushing baseballs. He's one of the only two hitters in baseball to hit over 400. He wrote this book called The Science of Hitting, and I found the book when I was helping my grandpa had passed away. I was moving his stuff out, and I found the book. I started reading it, and in the book, Ted Williams draws a strike zone, and he's like, if the ball was in this little corner of the plate, he was batting 600. If it was anywhere else, he was batting like 250 to 280. And in the book, he goes, the funny thing about baseball is even though that wasn't the pitch that I like, I still had a swing at it. Otherwise, it was a strike. But he goes, in life, sometimes you don't have to swing at every pitch, right? So you can have a buy box, which is your strike zone. You can have an idea of what you're looking for, but that's blessing and a curse in this business is that you don't have to swing at every pitch, right? So if the deal's not for you, then don't do it. Because you'll save more time and headaches like by just waiting to get the deal that you want versus like just coming up and buying anything that presents itself to you. And so I think a lot about that book. You don't have to swing at every pitch.
Did you have advisors in your corner? So you read books, which I love books. I have a huge library of books that I read. Did you have advisors in your corner who were able to help you get sort of the first acquisition out of the way? Because there's a lot of things that they're hidden around corners that you can't see around those corners necessarily. But if you talk with someone who is already gone through a few acquisitions, ideally even in the CPA space as well, you can ask them what problems did you run into. So like, did you have advisors? What was your experience using advisors if you did have any?
I had advisors. I had one or two friends that have already bought CPA firms that kind of gave me advice on what to look for, what to put in the contract, what not to put in there, things that I'm going to run into. I'm actually a part of this group called Advisory Board, which is a group of people that buy. I mean, they're buying like way bigger companies than I am. Um, but yeah, I think surrounding yourself with people who have done it before is extremely helpful because you don't know what's going to be up around the end of that corner, but somebody is going to know. Like so, for example, one of the things that I didn't know um, in this deal that I'm working on now that's set to close by the end of the year is that the senior debt position on the new company, they want me to get the previous owners to subordinate their earnout below the senior debt, right, of the conglomerate of all the companies. And that's not something
So
that I knew.
just to put that into terms for people who may
Yeah.
not understand that, senior versus a subordinate is the person who's going to get paid out in the event of a liquidation, bankruptcy, or if things go sideways. Who's the first person to get paid versus who's the last person to get paid?
Yeah. And so this company that I'm buying, that I'm taking on senior debt on, I didn't know that at the time that they would want to subordinate their position before the owner of the company that I had already bought, right? So had I have known that, I could have put that in the purchase agreement of the first firm that says, "Hey, I'm able to subordinate your earnout in the future," right? So that's just things that like. Oh, I wish I would have known that.
Interesting. So yeah, you really focused on being able to figure out who wants what in a deal because deals are very liquid. It's not just a Boolean like if you're buying a car or a house, maybe a house is an easier example. If you buy a house, there's only so many variables that you have to play with versus in a business, you have so many more variables that you can play with. And real estate's relatively fixed, whereas businesses are very fluid. And one of the things that I learned was people were trying to sell me businesses based off of what I was going to do to the business. And so let's say their business is just not worth a ton of money. Like on paper, it's like, hey, where the business is at right now is not worth a ton. I usually don't share people what I'm going to do after the business because that's not in my best interest as a buyer. So if I see a really good opportunity of like, oh, if we just put our playbooks in there, we could probably double this within 3 months. That's a relatively common occurrence for us. But if people get the sense that we're able to do something that they're not able to do, they may try to turn around and say, "Hey, I know that you agreed to pay, let's just say 5 million for this. I want 10 million for this because I know that, when you fix it, it's going to be completely different." Like, "Whoa, hey, I'm not going to buy your business based off of what I'm going to do with it. I'm going to buy your business based off of how it is currently." Same thing with the house. If you buy a broken house, I'm going to buy the house as is and then fix it up, and then if I, choose to keep it, if I choose to sell it, whatever it may be, that's none of your concern. What's more of a concern is what the current value is. And I think that's one of the things that people kind of forget is selling the dream, but not in the way that of what you're going to do it. Sell the dream of what they want and asking, what does the seller want? What do you want to do afterwards? And I think that's one of the things I learned from one of our advisors who was in the family office space on the buy side for over 15 years. He was saying one of the most important things that for us is that find out what the buyer wants and sell them that. Sell them the metaphorical plane ticket, if you will. Sell them the destination, not the plane ride there. What are they going to do after the acquisition? Do they want to stay on? Do they want to help grow? Do they want to go on vacation? Do they want to spend time with their family? And then saying if that's important to them, right? And you can't force someone to sell. I mean, you can, but it's called a hostile takeover, which we don't do. But generally, on these sales that are optional, it's way easier to get someone who's interested and has something else that they want to do after the acquisition.
Can I ask you a question?
Sure, yeah.
Once a once a price has been agreed to in a business deal, let's say there's a purchase option agreement or a purchase agreement signed, does the price ever get higher?
Very rarely, most of the time, the price will go down. It mostly depends because the seller, whether intentional or not, may misrepresent things. And I like to give people the benefit of the doubt. And if I do sense that someone was intentionally misleading, I'll just straight it back out. You can't do a good deal with a bad person. So I just won't do it. Um, there was one person that we were considering acquiring this business. It was an accounting firm, and he turns out was about and he did not disclose that right away. And so he's like, "Yeah, I've been trying to sell for 10 years." He didn't tell me why no one had bought his business. He just said he was trying to sell. He was like in his 70s, so he was older on in age, and he really wanted to get out of it. But I said, despite what may or may not have happened, I just can't ethically do this deal. And so for him, the price went to zero. But for other people, if it's maybe the client, I had someone who came to me and said, "We are valuing this at a software company. Like this is a software company." And I looked at it and due diligence. I said, "Where are the revenues coming from?" I said, "This is not a software company. And even if it was, your churn monthly is like 90%. Like this is not a software company. And if it was a software company, your valuation is unrealistic." I said, "This is an info product with a software attached to it." And so that was one of the things that like completely changed the value of the product. He wanted 10 million for it. I said, "This is an info product, which should, you're wanting like 30x. This should be 30x cash flow. This should be like 3x cash flow, like a tenth of the price that he wanted." And he did not like to hear that. But I said, "You can't say that this is a software product. Even let's say I go out to a bank and ask for a loan for this acquisition for the part that, we have the equity portion and the debt portion to go buy this business. If we go to the debt portion and say, yeah, this is a software company, we go to software lenders, they're going to tell us to get lost and that we're crazy because this is obviously not a software company." And so, and I told him that, but he just would not give that point up. That was a very big point of contention for him. He said, I want this valued as a software company. I said, "You can want it however you want. This is not a software company. This is an info product with the software attached to it that people churn out of the software very fast." So I say that's an example of someone who's, the price changed, even though we agreed on a price. It went down even after we signed the documents because he said this is a software company. We signed the agreement, started doing due diligence, and it was not what he said it was.
But my claim to fame on this is that in real estate and businesses, I've never ever seen the price go up. Now,
Hmm.
I don't do probably as many deals as you guys do because you're advising clients and you're probably way more in tune with the space as me. But, I've helped over hundreds of deals on the real estate side. I've helped clients buy and sell businesses too. I've never seen the price ever go up after the agreement signed because it doesn't happen. Like in a real estate deal, what happens is buyer and seller agree to a price, they sign a contract. Buyer is going to have contingencies in there like appraisal, inspection, financing, right? And so when there's a push and pull between buyer and seller on what information you want to disclose and at what time. See, if I'm a buyer, I want to lock into an agreement at a price, and then every time something comes up, we call them skunks of a deal. Like every time something comes up, we're just figuring out how we can be made whole from that. Like, oh, the roof needs to be replaced, so then we got to reduce the purchase price by this much, or we need a credit, right? Um, or electrical, plumbing, whatever. Same thing in a business. But if I'm a seller, I want to lay all the skunks out on the table, right? I'm gonna tell you that the roof is bad. I'm gonna tell you that the plumbing is bad. I'm gonna tell you that, the electric needs work. But then if we agree to that price and it's an as-is sale, then you can't come back and say, "Oh, well, this is wrong. I need the price to be lower because I've already told you that." You know what I mean?
Yep.
So, yeah.
One of the best stories I think I've ever heard of this is an acquisition that was by a Fortune 500 company that was buying a much smaller firm that was in the newsletter. So they were buying a portion of their marketing instead of spending it on, Facebook, Meta, Google, whatever it may be. They wanted to acquire a newsletter to help market their product. And this founder had already been through the acquisition process for the previous 8 months, and he said it was like one of the worst times of his entire career. And they came up with all these reasons about how they were trying to beat him down on the price for the acquisition. And so he had this list of all the things that they hated about the acquisition, which ended up not going through the first time. And when he got the next letter from that Fortune 500 company saying, we're interested in acquiring, he sent a letter and said, hey, here's all the reasons you wouldn't want to buy the company. If any of these bother you, I've just saved you the time. I've saved me the time. I just wanted to let you know. And here's a reply to the email. The buyer was, yeah, thanks so much. We're still interested in talking. And so I think that was a really interesting way to lead the conversation of here's all the reasons you wouldn't want to buy our company. And it ended up turning out really well for you. It ended up, selling for a very good multiple and made himself a good, decent chunk of money. And it was all because he just led with, here's why you wouldn't want to do the deal. And they said, none of these are deal breakers. Let's do it. I think that radical honesty can be pretty helpful as long as you're working with good people. You're doing a good deal with good people. And I want to be clear too. I'm not just trying to get like how cheap can I get the price. Obviously, we have a fiduciary responsibility to our shareholders in terms of like people who have given us money for an acquisition. We have a financial responsibility to make sure that we're putting their money to work in a good way and we're not being wasteful for it. I hear people, are saying like bragging about how they're overpaying for a business, and I'm like, that sounds awful. You have just hurt yourself and the people who've sponsored you, given you money for this deal, whether it be a bank or in which case it's yourself because you have to repay that, or if it's an actual investor who gives you an equity investment. So we try to make sure that it's a fair price for both parties because we want to have a good reputation in the marketplace of if we buy this company, are other companies going to know if you do a deal with them, they will try to get the best, like absolute super bargain price, and they will try to jib you and beat you down on every little thing. Versus, I think a fair price, your reputation will precede you for better or for worse. And so for us, I want the reputation to be, hey, they are tough but fair. They will give you a fair price that is reasonable for your business, and that's fair for both parties. And that's what I want as a fair exchange because this isn't going to be our last acquisition. We're gonna acquire many more. And so that for me is like really important. How do we make sure that that reputation goes through and that other people say, yep, I sold to them. They were very, the transaction was very good. It went through. Obviously, it's a transaction. There's always stress through any kind of I mean, maybe I haven't been to the right acquisitions, but I think that every acquisition has some amount of stress. So that's the lens that I view buying a business from.
Mhm. Smart.
I think one of the things that you talked about was hiring employees that, and I think this is actually something I disagree with you on too. Breaking the sound barrier. You hire employees who want to break the sound barrier, and versus people who are okay with just playing ball where they're at. Um, Tell me a little bit more about that, about what it means to you to find the right people for the right role who want to see themselves doing the role that you hire them for, not, hey, in 5 years, I want to own my own firm kind of thing.
Yeah, I just especially in we'll just say this. I would say like um financial service industry, mostly male dominant, at least on the client service, client service side of things is going to be male dominant. Um, there's a there's a catch between like and I wouldn't say it's just hiring anybody in general, but so for example, like if you hire somebody from a company, like let's say you poach somebody or you take somebody from a company and then you want them to do the same exact thing in your company, but you're going to pay them more, they're just going to wait and jump at the next best opportunity to do the same exact thing again and make more money, whether that's doing it on their own or a different company. And so there's like risk from an employer perspective because like, well, I got to pay a marketing fee for this person or a recruiter fee. I got to train them. We're giving them, in some cases, we're giving them our like IP and like the way that we do things so that they can, go run off and do it on themselves. So I need to be more, I'm trying to be more careful of who we hire in the future about, especially in those like client facing roles. Because I think there's a difference between the client facing roles and then like the back office roles.
Hmm. Interesting. And I know that, for example, in like doctor world, where you have dentist or some small practice firms, a lot of those firms are started by doctors taking employee or taking patients or customers from that business and going off and starting their own practice. So I know that can be a big issue.
Yeah.
I think there has to be some good way to align incentives with a high level employee to be able to capitalize off of that. I know plenty of really big employers, very professional firms that have really great reputations that you go work there for a little bit, you're gonna work very hard, but when you leave that place, you're probably gonna make way more money than you ever would have on your own because of that reputation of working at a very high-end firm. Um, hmm, interesting. I think that's the same thing with Deloitte though too. Deloitte, I think less so because there's probably a lot of incentives to not go off on your own. You probably have to sign a lot of documents and non-competes and that kind of thing.
Yeah, and I don't know if anybody would ever get to the big enough point where they'd be able to like poach a Deloitte client per se, just because of the amount of staff that's probably involved in that whole deal. But in like smaller advisory shops, sub 10 million in revenue, like mine, it would be very easy for somebody to leave and run off with a bunch of clients
Yeah,
because they could just be like, hey, you're doing it with this firm. We have all this back office. We have all these fees. Like you can just come on and on board with me, and it'll be a third of the cost. Two-thirds of the cost, right?
yeah. Well, I agree. I think no one ever gets fired for hiring Deloitte kind of thing. I think that's a was that Deloitte or something else? Someone else. It was a big consulting firm. So no one ever gets fired for hiring a high-end consultant.
Mm, probably McKinsey.
McKinsey, I think that's what it was. Yeah. No one ever gets fired for hiring McKinsey because you hire someone, even if they make a bad decision, you're like, well, hey, McKinsey suggested it. So one last
Yeah, they're
question, we'll
like
wrap
the
it up.
scapegoat. Yeah.
What do you think is the sweet spot for acquisitions? What do you think is the perfect size for someone who's maybe looking for their first acquisition that they've spent some time learning to run a business and now they're looking to go off on their own? Like, what's a good size for acquisitions?
I have different opinions on this based on what industry. Um, but if you ask me, the because when you buy a business, the work never stops. Like you're going to be a business owner 24/7. So if you were used to being like, a really good employee putting in like 45, 50 hours a week but that's it. And then you want to go buy a business, like congratulations. Now you have to wear all the hats. So you have to think about like what is the SDE of that business going to be after I buy it? And is that a salary that I'm comfortable with like earning to learn? More than anything else, like learning how to be an actual business owner versus just a W-2. Um, it's funny, I've had employees try to get equity in the company before, or like, and it always comes down to the same question. It's like, hey, you want equity? Okay, well, hey, payroll's coming up on Friday, and I have to renew my insurance. That's 18 grand a year for, insurance. Do you want equity? You want equity to pay part of that? And of course, the answer is always no, right? And then that conversation kind of stops. But like, I would try to target maybe like if I was a W-2 employee making 200K a year, I would try to target and buy a company where the SDE was at least 400K, probably double what you're used to making. So that way it's because when you're going to put in double the time or maybe like
SDE,
50%
seller's
more time.
discretionary earnings. I want to make
Yes.
sure that's good. So
Sorry.
how much the person's taking home every year.
Yeah. Yeah. Because that's kind of how at least it worked for me. Like I said to myself, okay, the first year that I leave Deloitte to start my own thing, I want to make at least 150 150 net, and it ended up being around maybe like close to 500. But like
Nice.
2 to 2.5x SDE is like it makes it worthwhile to you. Like it's enough to be able to, log in and handle that thing on a Saturday or a Sunday. Or like, I mean, even yesterday I was filming videos, new landing pages for funnels that I'm setting up. It's like if I was a W-2 employee, I would not be filming funnels on Sunday. I'd be watching football. Um,
Yeah.
but now that I'm a business owner, I get to watch football and do funnels at the same time. So there's that, right? So I would say like I would target like whatever if you're thinking about buying your first business, the seller discretionary earnings should be like at least 2x of whatever you're making right now,
Hmm. So
like
yeah,
as a
to
starting
make
point.
it meaningful, and then also being able to pay. If I'm assuming you're most likely if you're a first acquisition, you're not going to be doing an all cash deal. You're probably going to have some blend of debt in there. So you have to also keep in mind how much you're going to be paying off towards the debt of I bought this thing, now I got to actually provide for it.
Yeah, but it holistically, from an accounting firm space, if that's your jam and you're looking to buy those, I think the biggest opportunity right now is the 2 to 3 million revenue firms. Um, they are big enough to make it worthwhile. They have some level of staff and different titles. It's not just a sole prop solo person operating. They are not big enough to where um, there's going to be like multiple partners involved, stakeholders, et cetera. Maybe at most there's like two partners, but I try to target like $2 to $3 million revenue firms with one owner. So then I only have to convince one owner to make a deal versus three or four at a time.
Oh yeah, no, it makes yeah. Otherwise, you're having so many people who are at the negotiation table. All of them have different interests, so they want different things. So getting them to
Yeah.
agree just becomes exponentially harder.
Yeah, one guy wants to get bought out right away, so the the cash down plus the loan has to be big enough to be able to buy him completely out. And then what about the guys that want to stay on? Well, like they don't need to be completely bought out, but then they just saw this other guy get a bunch of money and they're kind of feeling some type of way. I'm saying this because it's happened before, right? Like
Yeah.
I've tried to do a deal with four partners and they all want different things, and it's so hard to get them to the finish line. Um, so I'd rather just try to go find this a similar style revenue comp company with just one owner. I mean, hard to find, but worthwhile.
What do you think about using business brokers for this?
Um, so it's kind of like in the beginning when a firm gets listed on a business broker website, it's already been combed through 6 or 7 other people. Because in order for it to go on a broker site, it has to get listed by a broker. And that person's going to have their Rolodex of connections of people they think that, like, either people that bought with them or sold with them previously that might be interested in that. And so before it even hits a broker site, it's already been picked through 5 or 6 people probably before it gets listed. Now, I think if you can find something that's been listed on there for, 4 or 5 months and it hasn't closed, and the longer that time drags out, the more likely you are to get a good deal especially if you can understand like why wasn't this sold in the past? Like what were the reasons why it didn't sell? That same firm that I'm telling you about, that 1.8 million revenue, 800K in seller earnings, right down the street from me. It's been pending like 3 or 4 times in the last year and a half. It's just been sitting there because whoever is like trying to buy it probably realizes like, well, shit, how much work is involved with this? There's 5,500 clients,
Hmm.
you know. Um, to buy something with that much clients and that little in revenue, you would have to have all your upsells ready to go. Insurance, annuities, lawyers, estate planning stuff. But then at the end of the day, it's like how many of those can you actually sell because the client's only paying $200 for a tax return,
Yeah.
as opposed to well, you're buying a book of business where the clients are used to paying $5,000 for that work, right?
Agree. I think that there is I've seen the best deals where there was some uncapitalized resource in the business and the acquirer had the advantage to take advantage of that and sell them products. One of the best ones I ever saw was an email list of 8 million different consumers, and they were selling some really basic $20 product. And so they bought the list from the person who went out of business. They just bought the list of people because they had already opted in, so they had that consent, and then they just started hammering that with offers to that list and liquidated it in like the first month. It was one of the craziest acquisitions I've ever seen in terms of like time to value. Because to the person who was selling it, it wasn't worth a ton. To the person buying it, it was worth a lot.
A buyer is a buyer is a buyer.
Yep.
So
Ryan, it
much,
was great talking with
so
you.
much more value. Go ahead. Sorry.
It was great talking with you. Where can people find you on socials?
I'm on all social media platforms at Ryan Bakke CPA.
What kind of call to action you want to put in there?
Oh, just if you're interested in this journey, shoot me a message, DM. I will not get back to you the same day or the next day, but I promise I'll get back to you eventually.
Is that for people looking to acquire or people looking to sell?
Yeah, anybody that needs
Fantastic.
help.
With CPA work?
Yeah.
Great. Fantastic. It was good talking with you, Ryan.
Yeah. Thank you so much.
You betcha.